Welcome back, friends. Today we are going to work through an interest capitalization exercise. With that, let's get started.
So on December 31st, 2019, a company borrowed $4.2 million at 12% payable annually to finance the construction of a new building. 2020, so they borrowed this money in December. So it was, the whole amount of this loan was outstanding the whole period. That's kind of important. It's not always the case. So the full amount of this loan was outstanding the full period. It was actually outstanding before they started construction, which is meaningful, which you'll see here in a minute. So the company made the following expenditures in March. They spent $511,000 in June, another $852,000 on July, $2.1 million, and in December, another $2.1 million. The building was not completed until February of 2021. So what we are going to be focused on is the year end, December 31st, 2020. We are not, and that's where everything's going to end, which you'll see. Now, because the building wasn't done until February, there's going to be additional interest capitalized in 2021, but that is outside of our period for this question. So moving on to figuring out this. So what we've got here is a couple different steps. One, we're going to figure out what are our expenditures with the goal of we need to get the weighted average accumulated expenditures on the building. That tells us on average how much over the course of the year, on average, how much did we have outstanding associated with the construction of this building. That matters because that's the amount that we're going to calculate our avoidable interest on. Now, let's say we had, I don't know, $2 million on average outstanding for the whole year. Well, then that $2 million is what we're accumulating interest on for the avoidable interest calculation. And if you remember back to when I walked through the slides, the amount of interest we get to allocate or capitalize associated with this construction is going to be the lesser of the avoidable interest or the actual interest for the company. So to calculate avoidable, we first have to know how much the cost was of the building. So what were our expenditures? So we're going to calculate our weighted average expenditures. We had 4 expenditures. They were on March 1st, June 1st, 6/1, July 1st, and December 1st. Okay. And they were in the amount of $511,200, $852,000, $2,130,000. I think that's the right number of zeros. Yep. And then another one for $2,130,000. Okay, so we had total expenditures of $5,623,200. Now, they weren't all outstanding for the whole year. As a matter of fact, most of them weren't outstanding for even half the year. So we didn't start expenditures until March. So if we were to look at that, we have March through December. That is actually 10 months. So we're going to do 10/12. June through December, because again, these are for financial statements as of December 31st. So we need June through December. That's going to be 7 months. So that's going to be 7/12. July, all of July through December is going to be 6/12 or 1/2. And then December is going to be 1/12. So that is our capitalization period. Now, our weighted average accumulated expenditures are going to be the amount times the capitalization period. So 426,000 is 511,200 times 10/12, et cetera, et cetera, et cetera, which gives us a weighted average accumulated expenditures total of $2,165,500. So that was the weighted average amount outstanding or used for the construction of the building. So that's the amount on average across the year of cash it required to do this building. Now the question is, okay, well, what did that cash cost us to borrow? Well, we borrowed $4.2 million at 12%. So we're going to, if we, for those of you who saw the lecture last week, as I mentioned, we start with the specific debt. If there is specific debt for the construction, that's the debt we use first. So in this case, the specific debt was $4.2 million. Our average expenditures were 2.1. the full amount of expenditures are covered by the specific debt. If they weren't covered, let's say we only had specific debt of $2 million and the rest was we're just going to use company funds, well then only the $2 million would get charged to the 12% rate, and the other, $165,000, we would use actually a weighted average rate of additional debt that the company is carrying during that time to come up with the avoidable interest. But in this case, it's all out of the specific debt, which is at 12%. So our weighted average accumulated expenditures are 2.1. Our interest rate is 12%. So our avoidable interest is the average expenditures times the rate, 12%, gives us $259,860. So that is our avoidable interest. And now we get to capitalize the lesser of the avoidable interest or the actual interest. We know the avoidable, now we have to figure out what the actual is. And our actual interest is going to be the three pieces of debt we have outstanding. We have a specific borrowing, and then we have these two, the 10-year and the 6-year notes. So our actual interest is going to be, let's see, the $4,260,000 at 12%, and then we are going to do that was at 13%. And then we had $2.2 million, and that was at 10%. So extend those over. Our interest associated with those three pieces of debt totaled $1.4 million. $1,476,800 was our total interest for the year. That was our actual interest costs. Well, we get to capitalize the lesser of the avoidable or the actual. So in this case, we're going to capitalize, well, the avoidable is less than the actual. So our interest capitalized to buildings is $259,860, which is our avoidable interest for the period. So that is the amount capitalized, and that is how we calculated it.